What is good, guys? Welcome back to the channel, and today's topic will be my approach when it comes to achieving more consistency. Before we get into the actual filters I use to achieve that, I quickly want to explain the mindset you have to adopt when it comes to trading. Let's say we have here a number of trades you've taken, and you can see here you take a win, a loss, a win, and overall you have winning trades, but within those winning trades you always have a chain of losing trades, meaning at the end of the week or at the end of the month you had some decent trades, but within those trades you have so many mediocre setups which end up being a loss that at the end of the day you have a negative P&L, or you're always being around break-even and you never achieve that consistently upwards going P&L. Now, what most people don't get is that achieving consistency comes from doing less right. The key to having a higher win rate and therefore a better consistency in the trading is trying to avoid those mediocre setups which are within those high probability trades. So, for example, in this case, we have 10 trades, and as you can see, we got 1, 2, 3, 4 wins and 6 losses. Now, simply if you would be able to reduce, let's say, 1, 2, or 3 of those losses, then in total your win rate would increase from 40% to now in this case you have a total of 7 trades and 4 out of those are winning trades. So you have a win rate from around about 60%. Now that's the exact goal. You want to take less trades, but at the same time you want to increase your win rates by avoiding the low probability setups. And that's exactly where my routine comes into play, which is based on 3 steps before I actually start to look for my execution and look for my setup on the lower time frames. And the first step I always use, if it's worth to even determine a bias or a narrative, is first of all trading conditions. So what do I mean by trading conditions? Trading conditions are always relative to your system. But as most of you guys trade expansion profiles because you trade either short or you buy, and therefore you expect an expansion. So if price is in a consolidation profile and price does not expand into either direction, you obviously don't have the framework to look for a setup. Or you can be in a trade, but price just ends up being in a consolidation profile and doesn't move anywhere. That's why trading conditions are so crucial, because if you can anticipate if price is most likely in a consolidation profile and you therefore don't even look at the charts, you can avoid most of the bad setups. And the main 3 indications for trading conditions are those ones here. The first one is higher time frame consolidation. If you see already that the previous daily candles have been trading in a tight range, then you also want to assume that price continues being in that range unless we trade below the range lows, above the range highs. For example, we have an economic news release which could inject volatility into the marketplace. But as long as price is consolidating within that range, you don't want to look for setups within that range, because until proven otherwise, price is in a consolidation profile and you're better off to only look for trades at the range extremes, meaning range high, range lows. Once we then should see a manipulation to, let's say, the range highs, and then we see price, for example, breaking lower, getting back into the range, then you can say now price is most likely here in an A and D. We have the manipulation of the range highs, price breaks back into the range, so I can anticipate that price most likely wants to transition from consolidation into again a higher time frame expansion profile. And if you are then in this expansion profile, that's again where you can expect price to give you a framework to look for trades, meaning you can look for shorts and ride this expansion to the downside. Now the next thing which comes after expansion is always consolidation. So if we have already seen a large expansion and we, for example, trade into a higher time frame liquidity pool, for example, an old weekly low or a daily low, depending on what time frame you execute, then it's always low probability to look for further continuations, but it's also low probability to look for a reversal, because price, every time we hit a higher time frame objective, we are most likely heading into consolidation to then either continue the bearish order flow, or price is going to reverse again once we take out this low. Meaning you have the same framework as here. Price is in a consolidation and until proven otherwise, you don't want to be engaging within that range. The same applies also when it comes to your intra-session or intraday narratives. For example, if you see Asia and London session already expanding heavily and we have met the average daily range, then looking for a further expansion into the same direction in New York session is low probability, because yes, price might give a third expansion profile in a row, but simply using common sense, you know that if price already met the average range, it is extremely unlikely to see a further expansion. And that's the third point, overextended price action. And then the second part of that last point is trapped order flow. Now, what is trapped order flow? Trapped order flow is pretty much if price in a ranging profile and is not willing to displace to either side. Why? Because price is trapped between two opposing PD areas. For example, if we have price moving lower here, and then we leave behind here a bearish imbalance, at the same time price trades here into a bullish imbalance, which is resting below this higher time frame old low. And then you see price tapping the imbalance, trading higher to this upper imbalance. And if price is not willing to close above this imbalance and instead rejects back lower, price is most likely in trapped order flow and will consolidate between those two opposing PD areas. Now, this can also be the case with any other PD array, for example, order blocks. And the key thing is here that as long as price is then respecting both PD arrays and is not willing to close below the bullish one, but also not able to close above the bearish one, you don't want to engage again at mid-range. You can look for shorts at the range highs and longs at the range lows, but for a higher time frame expansion, or before you expect a higher time frame expansion again, you would want to see price to close above this bearish imbalance, and then you could look for again expansion into, let's say, an old high here. So that's already the first step I always ask myself before I look to frame a trade setup. Then if we go to the second step, it's pretty much once you have determined your trading conditions, meaning you can expect expansion, then you should ask yourself, do I have a higher time frame daily bias? Because if you don't have that higher time frame bias, you pretty much just dabble in the blind and don't know what to look for. If you have, however, a high probability bias, meaning you expect price to be bullish or bearish the next day or even the next session, depending on what time frame you trade, if you intraday trade or intra-session trade. But if you don't have that bias, you don't know what to look out for, meaning what key levels, what potential underlying narrative do I want to look for, where do you want to see price manipulating into a session open, and so on. So having no bias is also fine, right? If you say I don't have clear bias and you therefore have conflicting narratives, for example, you can frame a bullish case, but also a bearish case, then that's always a low probability environment to trade. Doesn't mean you can trade, but then you need to have defined if-then statements, meaning if that happens, I will do that. If this happens, I will do this, or I will do nothing if none of this happens. And that's pretty much the framework you always have to think in. If this happens, I will do that. And those if-then statements, you should already have determined ahead of the trading day and ahead of your trading session. And those if-then statements should already be determined before you head into your trading day or you start your trading session. Now, you might ask yourself, if I do all of those things, expansion, expectations, bias, and narrative, obviously the narrative is always how is price moving, meaning the first step is always the bias direction, and then the second question you ask yourself is how is price most likely going to move according to my bias. So if you already have applied those two steps, step 1 and step 2, you've already filtered out most of the low probability days and sessions. And the key thing to understand here is that yes, applying all of those things will result in you taking less trades, also watching the charts less, but most people confuse that with being unproductive. But in trading, being unproductive is not correlated to how much time you put in. So learn to get comfortable with doing nothing. Doing nothing in trading doesn't mean you're unproductive. It just means you know exactly what to look out for and you avoid the other days or sessions where you know they are not high probability. For example, this month so far, I've taken a total of 6 trades. So it's already the 16th of July and I've only taken 6 trades so far this month. 2 of them were today. So in the last 2 weeks, in a total of 10 trading days, I've only taken 4 trades, meaning most of the sessions of the last 2 weeks, I've pretty much done nothing. I just waited for price to align with my expectations, and then like today, when the opportunity is arising, I know exactly what I want to see in price and then act accordingly, and then I increase my risk and my trade frequency. Now, the final step before you actually look for a lower time frame entry model to frame your trade is you always want to have a higher time frame key level. For example, a daily key level, which can be refined into an hourly or H4 key level, to then use that key level to frame your lower time frame execution based off. So you have your key level and you're bullish, for example, then the next thing besides having a key level, you always want to make sure that you have a stop run before you enter a trade. All high probability trades only form once a stop run has occurred, meaning you want to look out for a high or low which is resting close to the key level, and then you want to watch for price to run the stops of that low into the key level, and then that's where you can look for a lower time frame entry model to then frame a trade based off. Also, other confluences which you can apply are session profiles, London reversal, London continuation, or the same for New York session, a reversal continuation profile in play potentially. Then that's also always a high probability confluence that you have the right narrative and the right bias. Now, if we go back to the initial frame, let's say you have those 10 trades, but now because you apply those 3 steps before for your entry, you can avoid half of those losses you had before. Then you can literally have a night and day difference in your trading consistency, because instead of having now 6 losses out of 10 trades, you only have 3 out of 7 trades. And yes, this comes with taking less trades, but the goal is not to trade a lot, the goal is to have consistency. And that comes with doing less. And you also become more consistent because you have to make fewer decisions, meaning in this case, you have to make decisions on 10 trades, while in this case, you now only have to make decisions on 7 trades instead of 10, meaning you have less room for errors in your decision making, since you now can use your mental capital, which is also limited for each day, each week, and can focus and put that entire mental capital on those trades which are really high probability frameworks. Obviously, this doesn't mean you won't lose anymore, since that's obviously part of trading, but it definitely helps you to avoid those losses which are caused by mediocre setups and trades which are based in low probability trading conditions. And this concludes today's video. If you found it valuable, then I would appreciate a like and a comment, and see you guys in the next one.